So hello everyone, and I truly hope everyone is doing well and your families and friends are all well during this horrendous time. This has been really a struggle for everybody. So what I want to say is we're going to pick up on chapter 7 today. So reminder, tomorrow is your midterm, which has been delayed now several weeks. So you should have read the chapters and gone over the slides and been quite ready for it, okay? And I delayed chapter 7 homework, okay? So remember, the midterm is on chapters 1 to 5. All right, so we're going to talk about stock evaluation today. The way we did with bonds, right? And stock, there's differences between bonds. Bonds are debt, right? And stocks, which is also known as equity, right? With stocks, you vote, so technically you have a voice in management, even though in reality most people don't, right? Because the majority shareholders have most of the votes, and you're a stakeholder, so you have claims on the income and assets. You're typically own the company. You're a shareholder, right? You own it, okay? Now, technically stocks never don't have a maturity. Technically, they go on forever, even though companies do belly up over time, right? And how both are treated tax-wise is quite different. Companies can write off the interest they pay on the debt, but on the other hand, the dividends they can't. And okay, so and some stocks don't pay a dividend. You may not get one, However, you may you always get a coupon with a bond, okay? But if the company defaults, then that's the end of that for the bond. But there's differences between bonds and equities. All right, so when a company does go belly up, okay, how do they divide up the assets? The creditors, basically the secured bank loans or bonds. Remember, bondholders always paid first, right? And all the secured loans secured, and then comes the unsecured. Okay, and notice who's paid last, right? The equity holders, right? Equity holders are paid last, so they take the most risk. That should be obvious, right? So they get the most return. Okay. So here's a table that kind of shows what we just talked about a little while ago. And here's the debt, and here's the equity. You'll notice there's no voice of management for debt, and you are senior to equity when it comes to claims if the company defaults. And maturity, there's a stated maturity. Technically, stocks should go on forever. And here's what I mentioned previously: there's an interest deduction for the company for the coupons, but with there's no deduction on the dividends. So there's an interesting little note here about voice of management. Debt holders do not have voting rights, but instead they rely on the firm's contractual obligations to them for their voice. All right, so there's two types of stock, right? There's common and preferred. So common stock is the most common, I guess, right? It's you have ownership, right? And there's privately owned stock, right? And it's got private investors such as venture capitalists or angel investors. And it's not publicly traded. That's the way Facebook was before it went public, right? There was private investors. Okay, and then there is publicly owned, which we all love and know really well. And this is the common stock of a firm that's owned by public investors. And we trade amongst each other with this, right? It's publicly traded. And closely owned would be small group, like a family of investors, right? And that's different than privately owned. So this may be just a small. So there are subtle differences between privately and closely owned. I believe closely owned would be a lot smaller than the privately. This could have outside investors, where most of the time this doesn't. So there are subtle differences. And the most widely owned stock, of course, is common stock. We all trade common stock, right? And that's how that goes. Okay, so common stock has a par value, and the par value is an arbitrary number. Now, it's different than a bond. When a bond has a par value, the par value is typically $1,000, right? So that's the par value. But a stock, it's an arbitrary number that's established for legal purposes in the firm's corporate charter, and that can be used basically to find the total number of shares outstanding. So you take that and you divide that into the book value of the common stock. And we've seen that on the statements, all right? Okay, so the definition of a preemptive right and allows common stockholders to maintain their proportionate ownership in the corporation when new shares are issued. And this protects them from dilution of ownership. So basically, they get a proportional ownership in the corporation. And that's called a preemptive right. Okay, so there's another thing called a dilution of ownership. And that's basically a reduction in each previous shareholder's fractional ownership resulting from the sale of new common shares. Okay? So dilution of earnings is a reduction basically based on the new common shares that are issued, right? Earnings per share, right? The more shares in the denominator, the lower the earnings, right? And basically the rights of the common stockholder, and these are financial instruments. They allow stockholders to purchase additional shares. You will be given a right, if you're a previous shareholder, at a price below the market price if new shares are issued, right? So these are some of the definitions that are somewhat important, and they're described in more detail in your book. All right, so this term is important here. There's three words here: authorized, outstanding, and issued shares. All three of these are real important, and I suggest you understand and study these and read the chapter in your book on these. So authorized shares are shares of common stock that a firm's corporate charter allows it to issue. Outstanding shares is shares that are issued out to the public, okay? And treasury stock is when a company actually rebuys the shares back and they're holding it, okay? So basically there's three terms here, and these three terms are important, okay? So it's authorized shares, outstanding shares, and treasury stock shares. Okay, so let's look at this. Let's look at this example here. And basically, here's this company here. They've got basically, here's the par value. Everyone see the par value? Right there. This is the par value. And here's 35 million shares are authorized. This is from the balance sheet. This is the stockholders' equity portion of the balance sheet, okay? The 35 million shares are authorized, but 15 million were issued, okay? So 15 million out of the 35 were issued. And there's $1 million in treasury stock. Everyone see that? So here's that 15 million. And here is the 1 million. So basically that makes up 16 million of the 35 million, right?